Hello, hello, hello. What's up, guys? What is up, guys? What is up? Hope everyone's doing good. Whew, stress, man. Still in the trades from yesterday. I'll be honest. Um, yeah, man. It's a lot of market risk going on right now. It's very, very volatile. I didn't expect this volatility, but yeah. Anyways, welcome to the people that are joining. Yeah, it's volatile, guys. Trying to calculate my position for euro dollar. Euro dollar positions. I'm trying to figure out where my average is. In a big drawdown right now for this euro. It's not the best. It's really not the best, but it's okay. Not really fussed too much about this. Hmm.
Dollar. If we closed here right now for that currency pair, the biggest two-day move on euro dollar going back to March 2009. Euro dollar 113.58. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth, seeing more volatility ahead. The German finance minister joins us as EU leaders meet in Warsaw, and we'll catch up with Jared Cassidy of RBC as big bank earnings kick off later this hour. We begin this hour with US-China trade tensions sinking to a new low. Cameron Dawson of New Edge Wealth writing the following: we continue to think that volatility is here to stay, with the tariff reality creating non-linear risk to growth. Bond market volatility likely keeps equity market volatility heightened. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
It doesn't feel like the best performing week of the year for the S&P 500, does it?
Not at all.
What do you make of this chaos?
Yeah, so we think that there are certainly signs that liquidity is tightening throughout FX and fixed income markets, which just means that it keeps the volatility heightened. If this was Icarus flying close to the sun, the wax certainly started to melt on the wings on Tuesday night when we saw the bond market gap out and yields really spike higher. Now it's spreading into FX markets, which just suggests to us that liquidity is leaving this market, and we cannot rule out that these big moves continue.
Can we just sit on that relationship between bonds and foreign exchange? How unusual is it to see moves of 40 basis points plus on a 30-year yield in a week, and to see the dollar down at the same time by something like 3%.
It's extraordinarily unusual, and it calls into the question why. There was a great article in the Bloomberg this morning talking about how people are thinking that maybe there is Chinese selling, even though there's not a lot of hard evidence for it. The thing we ask is that if you think a big whale, a big owner of an asset is selling, does that mean that you try to get ahead of it and sell before they sell, which just creates this self-fulfilling prophecy of higher volatility and the risk that you have these yields continue to back up even higher.
Well, and the reason why people were looking at this in part was also because we had a 10-year and then a 30-year bond auction. A lot of people were saying potentially these would fail. They did the exact opposite. They did really well. There was a record amount of indirect bidders. And then the sell-off continued, which raised questions about whether there were different buyer bases, what's going on. At what point will you see stability enough for you to be a buyer?
Yeah, so eventually when yields get high enough, it draws you in because it allows you to be able to offset some of the price decline. You know, we've been seeing things like in the muni market. The muni market had its worst day in 30 years on Monday, and then it had one of its best days yesterday. So you have all of these flip-flops within the volatility and the price action of markets that we say when we look at munis, we'll step into that because if you can buy and hold, then certainly you can tolerate some of this volatility. But if you're trying to trade treasuries, good luck.
This has been a week of psychology on every front. You've been traveling around the country, getting a real lesson in psychology on all fronts, I'm sure. How bearish are the clients who you meet with at a time where Michael Hartnett of Bank of America is coming out and saying that right now many investors are talking about 4,000 on the S&P and just have this incredible feeling of negativity?
We're starting to see some of the optimism begin to fray. One of the things that's been the most surprising is just how resilient investor optimism has been through all of this volatility. The buy the dip mentality, we still saw really strong inflows on big down days. Maybe some of that is starting to wane. We can measure it by looking at the AAII equity allocations. It began the year at about 69%. It's at 66% today. At the lows in 2022, it got to about 62%. So people are still pretty all in on equities, which just means that they haven't thrown in the towel. And usually we see equity allocations bottom as the market bottoms, which is one consistent thing.
Do clients think that Trump will step in?
I think that given the moves on Wednesday, was it Wednesday? Given the moves on Wednesday, what you've created this environment is that you have a two-sided risk. You have the risk to the downside that this could all cascade further lower, but then you have the risk to the upside that you can have a 9-10% move in markets just because of one person changing their mind.
So when it comes to what do you do in this environment, are long-term treasuries even a hedge anymore?
It's a very, very interesting question. We think that eventually, if you see growth start to weaken, meaning economic surprises turn significantly lower, that treasuries will be a hedge because you have the flight to safety and don't rule out the Fed with quantitative easing. The challenge is you're probably unlikely to get hard data to weaken as much in order to draw people into this market and also to get the Fed to move at least in the next month. We think we're in that Wile E. Coyote kind of environment where hard data is still resilient because you have a pull forward dynamic of people getting ahead of tariffs. You also have the calm before the storm when it comes to inflation, which just means that the Fed doesn't have reason to act and you don't have the confirmation of that weaker data to get people to be drawn into the fixed income market.
Let's talk about the calm before the storm. Let's talk about the storm. UBS wrote yesterday, the growth hit is still substantial. It's not priced. What do you think about the prospect of retesting the low on the S&P?
We think the prospects are rising, and Chris Verone at Strategas put out a note saying that 85% of the time you do retest the low. And given the fact that we're not likely to have the Fed step in with a policy action, which was something that was very important to creating the V-shaped bottom in both 2018 and 2020, that just raises the odds of a potential retest. You have to step back and realize that this market's still trading at 19.8 times forward earnings. This is a very fulsome valuation given the degree of uncertainty and the degree of risk. You haven't really cut earnings estimates that much. 2026 earnings are still at $302 a share, implying 13% growth next year. We think that those numbers are still far too high, which just means that if you put an average multiple on a lower earnings number, you get to a retest.
So think about the phases of the risk aversion we've seen so far. The first phase was just broad-based, very intuitive risk aversion, equities down, price again, the greater prospect of lower growth and maybe higher inflation in the future. Second phase seemed to be a dash for cash. Starting to see some disorderly moves, some tension. What phase are we entering now? Where are we at the moment? Have we even exited phase 2?
Yeah, the weird phase where we're seeing the move in the dollar and fixed income this morning, and yet equity futures are up on that. So I think that we have to be careful not to read too much into one-day moves and extrapolate them into the future, that we continue to see this volatility in these wide bands. And one of the phrases we keep using is a Goethe quote, which is that few people have the imagination for reality. We have to have the imagination for this odd reality that we're living in.
How much do you think that this is a game changer when it comes to international flows into the United States, especially when it comes from Asia, potentially even from Europe?
It's such an important question, and we keep distilling it to something rather simple. If the last 40 years of the economic world order created an environment that was great for U.S. corporate businesses, allowed for operating margins to continue to hit new highs, for capital to be drawn into the U.S., to have U.S. assets outperform, if you completely flip that on its head, do you still have that same kind of dynamic for U.S. outperformance and U.S. capital flowing into the U.S.? You're completely switching around the world order of the last 40 years.
I hope you get some rest this weekend. Best of luck. Good to see you. As always, thank you. Cameron Dawson there of New Edge Wealth. Equity futures on the S&P at the moment, wild few days. Equity futures at the moment up by 0.5%. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. China will raise tariffs on all U.S. goods from 84% to 125% starting tomorrow. The Ministry of Finance said that it will ignore any further increases announced by Washington because the Trump administration move have become, quote, a joke. The announcement came a day after Trump increased levies on Chinese goods to 145%. Tesla has stopped taking orders in China for its Model S and Model X vehicles due to escalating trade tensions. The company's Shanghai factory only makes Model 3 and Model Y cars, while the Model S and X, the ones that it's stopping, are imported from the U.S. and subject to increased tariffs. House Republicans narrowly passed a budget outline paving the way for a tax cut package. It would cut taxes by up to $5.3 trillion over a decade and raise the debt ceiling by $5 trillion in exchange for $4 billion in spending cuts. However, conservative hardliners want to trim $2 trillion in spending, which may require curbing social programs. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny later this hour. Up next on the program, China striking back.
We'll see what happens with China. We would love to be able to work a deal. I have great respect for President Xi, and I think that we'll end up working out something that's very good for both countries.
That deal doesn't look close this morning. Up next, the view from Europe. We'll catch up with the German finance minister. Live from New York City this morning. Good morning.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Middle East and Africa, vibrant resources and high yield investment opportunities.
They're just fucked right now. I'm not gonna lie. Yeah, the markets are just fucked. I can't lie, guys. We just gotta be careful. You know. 1 second. Yo, can you hear me now? My bad, my bad. Yeah, bro, what's up, what's up, what's up? Yeah, the markets are mad volatile right now, bro. It's insane. It's crazy. So I just wanted to let you guys know, like, stay safe, man. Like, the markets are extremely, extremely volatile. My stop is over here somewhere. It's not a time to be risking a lot of money, guys. I would not risk a lot of money right now. I would just like be safe, because the Euro USD hasn't moved like this since 2009, guys. So yeah, so the things that are happening right now is history. China just made some new flipping tariff rules overnight. I don't even know, they added tariffs on US again. There's a lot of stuff happening in the background. But that doesn't really matter. What matters is that we manage the risk, because it's the market. It's risky right now. You need to survive, you know. I know a lot of you guys are putting in like big lot sizes, so just don't do that, man. Like, I'm in these trades, I'm staying in them. Like, I know these trades are gonna go back and go back to where I took them from. That's how the market moves. It always goes back. But the problem is, like, how much drawdown are you gonna take before it does go back? You know, like this Euro USD, I'm down 170 pips. It's a lot. It's a lot. I'm not gonna lie to you guys. But that's manageable. So Yeah, the dollar is cooked, like it's destroyed. Like this thing has been going down for like, it's gone down a lot, man. We're in, and the thing is also, guys, we're in a big range really in the dollar. Like this is the higher the range, this is the lower the range. It's clearly defined, as you guys can see. If I draw it for you guys, I'll show you. Hold on. So this is the highs. Ugh, let me get a cleaner chart, man, because this one's got a lot of stuff on it. Yeah, this one's better. So we're in a range like this, as you guys can see. Big range. You see, it dipped out of the range and it came back in, and now look, where are we at now? We're in the low of the range again. We've broken all these lows, so this is likely to go back up as well, at least to retest this part of the range. But we could have a thing where it does do this and then it goes back up. I'm just talking about what's likely to happen. At least I'm just talking about what's likely to happen right now. Yeah, that's what's likely to happen. But yeah, we just gotta be patient in these trades right now. This is looking like it wants to go up. There are some trades. I just don't want to send too many signals right now because I don't want to manage too many trades. But there are other trades, other opportunities I can tell you guys about. There's one called Pound CAD. I think this one might go up. I'm not in it, but I can see this one going up. This gold, I'm still in a short with this. I think my position, I've added actually onto this, so my average is going up on this position. But this is just nothing but a short. Like, do not buy gold right now. Just don't buy it. This is nothing but a short on gold. When is it gonna stop? I don't know. But no one can tell you that. But if you manage the risk right, you'll make money. I'm just waiting honestly for things to go down right now, to chill out. I've only seen this one time happen before, guys, and it wasn't pretty. But I'm not gonna lie to you guys, this is the way I work with markets. If I see something crazy happen that's never happened before, I'm just gonna do what I usually do in the markets, because 9 out of 10 times what I usually do is gonna work. This is just, I just sell this, this is what I'm doing. I'm just selling, and dollar costing averaging until I get, at my levels. This is one of my levels right here. It hit it. I didn't take one here. I took one here, I think, somewhere there. I can check right now. But yeah, like I said to you guys, I'm not gonna work on the anomaly. Anomalies are not common. It might be doing something crazy and it might keep going up, but I'm not gonna get scared. I'm gonna stay firm with my psychology. But there is a high over here. There's another level over here which I'm scared that we might go up. And this move, it looks small, but that's like that's 170 pips if it goes up here. There's another entry here, 1.15 on the euro dollar. Somewhere up here, man, like 1 point maybe. I don't know. It needs to break this high. I've got this whole section marked out. There is a high over here which I think it could go to today. I'm not gonna lie, it could go there, but I don't know. I don't want to buy it right now and just hope I'm getting a small move, when if you sell it right now you've got like this whole thing, it can go down. Like this thing is, if you sell it, it's more likely to go down this much. If you buy it, it's likely to go up maybe this much. So the risk to reward is to sell and be in sell positions. That's what the smart money is doing right now. Literally, that's what the banks are doing. They're not buying this. Nobody is spending billions of dollars buying the euro at this price. I'm telling you right now, that is not what's going on right now. Especially with gold. Nobody with billions, trillions is buying gold at this price. Nobody is doing that. Nobody's doing that. Now, it's all about surviving these positions, That's what I'm doing right now. I know some of you guys that took the signals yesterday, the stop loss got hit. I've re-entered a lot of these trades. I also send the updated signals, so you guys should be in it right now. I'm just being patient, man. I'm managing it. I can't show you guys how I manage, like, I can explain to you guys how I manage these trades, But when I send the signals, it's just one signal, you know. The way I'm managing these trades is, I'll tell you guys how I do it, okay? Is when I send a signal to buy or sell, I send a signal maybe over here or something like that, or whatever it is. I'm still adding to it the more it goes up, but I do have key levels, okay guys? I have key levels where I add to it at dollar cost average, okay? Like this euro dollar, I added to it here. I added to it here. I've got one here. I've got one somewhere here. We started yesterday over here somewhere, I think. Yeah, we started somewhere over here. But if you add to it, the position goes up. The risk goes up, but the position goes up, so you can get back into break even easily, and you can make money easier as well. But you have to manage the risk, man. You know, like you can't be going crazy. You know, I'm not trying to make crazy amounts of money. Like I'm good. Like a lot of people I know, they lost money yesterday. They lost a lot of money yesterday because they didn't manage their risk. You know, I go in small positions, guys. You know, I have a big, large account. I'm not gonna tell you guys how much it is, but it's large. And I use the same position sizes as some of you guys who have like $2,000 in your account or something like that. It's ridiculous. It's crazy. But that's how you make money. You know, you use small positions, you stay safe, because if you don't lose money and you only make money, then you're good. But if you make money and lose money, then you know, you might lose more money than you make money, if that makes sense. A lot of times you will lose more money than you make money in that way. If I tell you guys how the banks work, how they trade their money, it's crazy, man. They don't even use a stop loss, you know? They don't use a stop loss. They just stay in the positions and they stay in, because things are likely to range. You know what I'm trying to say? The market, if you look at statistically, the market ranges 80% of the time. You know, 80% of the time the market ranges. So yeah. What's up, Obi? What's up, Cleveland? What's up? Markets are volatile right now, man. Markets are volatile. It's crazy, bro. It's crazy. But yeah, guys, you know, markets are rangy most of the time, and they trend sometimes. They do trend. Right now, the markets have been trending, but when they have a big move, we're likely to consolidate or pull back. That's just what's likely to happen 80% of the time, you know. But you gotta be brave, and you gotta stay in your positions, you know. You gotta be brave, because you will get wrecked if you make the wrong decision psychologically. It's all psychology, man. I'm telling you guys, this everything I've done is psychology. Like, who the hell is gonna sell this right here? If you didn't see this red candle over here, look. Let me use the replay tool. Look at this. I'm selling this. I'm selling this. Look at this. This is going up like this. I'm selling it. And boom. Look, now we're here. Now we're here. I'm selling this, guys. So, you know, I can actually show you guys what's going on my account if you guys really want. But yeah, I'm down like a decent amount right now. I'll be honest with you guys. I'm down a decent amount. But I am dollar costing averaging, you know. I am dollar cost averaging. And I am gonna manage this. This is suspicious. Okay, I like how this is going down now, but I can see this doing something like this. Like, problem is, it's risky because it's not going down like how I want it to. But I can. There's a level on euro dollar actually. Let me mark it out. Hold on, where I think it can go to. Yeah, I think it might go back down here somewhere. Here. But what I'm scared is this might do something like this, and then go like that. You know. But if it does something like that, what I do, I hedge positions as well. So I can just take a buy here as a hedge. But we'll see. I don't need to do that right now. You know, I don't need to do that. My equity is kind of good. Everything like that. Like my risk is managed nicely. So, but yeah, you gotta manage the market, guys. We're in a crazy volatile market right now. Volatile market. Volatile. Like it's volatile. Like things move like 5 times what they do in a day. That means you need to take out 5 times less risk what you usually do in a day. Otherwise, you will lose money. Like I'm telling you right now, you will lose money. Even me, I'm like low key. I think I'm taking low risk, but because it's so volatile, with the low risk I'm taking, it's still like, you know, I'm down 5 figures right now. You know, I'm down literally 5 figures right now. You know, I'm down. Let me check in percentage how much I would say I'm down. I'm down maybe over 10% of my account right now, and I took small positions. So, you know, just being honest with you guys, if I'm down 10%, but that's not the worst thing ever, you know. You know, it shouldn't. It's a lot of money to be down 10%, but you know what's going on right now is also not normal. But it's how you manage it, you know. It's how you manage it. Right now, I'm waiting. If it goes back to here, you know, I'll probably get all my money back, and then I can reset and not have lost any money, you know. But I don't know what I'm gonna do if it gets back here. I might not. I might even hold it, because if it goes somewhere like here, I'll be up maybe 10-15%. I don't know, on my account, which is a large amount as well, you know. So I have to make decisions. What I might do when it gets here, I might just like reduce the position size by a lot, because my average would be here, you know. But I don't know if it's gonna get here. That's the problem. What I've seen before is when you get this doesn't look like it's done yet, you know. You get these spikes sometimes. You think it's done. It's called divergence, and then what it does, it will just break the high one more time, which is here, because there's liquidity now, and then it will go down, which is what I'm kind of yeah, it should stop dipping at your second red line. I hope so. I hope so, bro. I hope so. I hope so, man. Yeah, bro, the euro is moved, the way it's moved, bro, is crazy. Imagine this thing has moved, it hasn't moved like this since 2009. So I got caught off what do you call it, offside, bro. I got caught offside on that euro. This thing looks like it's gonna go up as well with this pound. So that's why I'm thinking, like, okay, if the pound's gonna go up, they usually kind of follow each other, you know. This is barely in profit. This gold is just doing what gold wants to do. What's the yen doing? Nothing. Yeah, just gotta wait. There is news today at 1:30. It could move the market. 1:30 UK time, but yeah, bro. You just trade crypto, don't you, bro? You don't really trade forex, do you, Keelan? But it's just all patterns I've seen before. The stuff is like, yeah, it's just patterns I've seen before, man. And this is high right now, so you know. This looks really interesting. I like this on pound CAD. I'm not gonna buy into it. I'm kind of like in too many things right now. Show you guys. I'm in this one as well. This one's very interesting. Alright, so this is USD Swiss, guys. Okay, let me show you guys the daily time frame, which is interesting. This price hasn't been here. Okay, let me change it to a monthly chart. This hasn't been here since 2011. Can you guys see that? 2011 was the last time this USD Swiss franc was here. Now, guys, when you break all these lows and you're at levels it hasn't been in 2011, and it looks scary as hell, you don't want to sell this. You don't want to sell the bottom. You want to buy the bottom, okay? I'm not trading anything right now. Market is just yeah, but it's too volatile. It's too volatile right now. But yeah, you just want to buy this stuff. You just want to buy it, you know. It sounds stupid to buy it, but look, every time things look bad, it was the best time to buy. Like, look at this chart. Look, when it was down here, if you didn't see this, you would not buy this. But then look, it went up, and it never came back to this level for 20 years. Anytime, bro, look, it looks big red candle. Look at this. It was bang. You didn't see this, remember? You couldn't see this, and then boom. Couldn't see that? Boom. Every single time. What's likely to happen here? Again, another boom. but it just looks scary, you know, and it's just hard to you can't time the market, man. You just can't time it. Now, what's gonna happen here? It's probably going to go up. I'm not gonna lie to you guys. It's probably going to go up. And I talk on probability. I don't trade on anything else. Just probability. I mean, obviously I trade on other stuff, but probability. Like, what's the probability that, you know, this is gonna go up? I'll say very, very high, like extremely high. You know, it's gonna go up. You know, you can say all this new stuff. The new stuff just makes it go faster. But bro, a lot of people have lost money from this going down, like right now. You know, and countries are not gonna allow it. Central banks are just not gonna allow this thing to go to zero, bro. This is the US dollar against the Swiss franc. Do you think the dollar is going to zero? No, bro. But that's what I love about currency. Currency can't go to zero. Crypto can go to zero. Um, you know, crypto can go to zero. You know, stocks can go to zero. But currency, nah, nah. It just won't happen. You know, it just ain't allowed, basically, in the simplest terms. Um, so yeah, man. This gold is very interesting. Divergence here. Look at this. Now you guys are watching the charts. I can see this later in the day dropping. Or maybe next week. Like, look at this price, man, of gold. Like, it's not gonna stay at this price. It just doesn't stay at this price, man. It just doesn't stay at this price. So yeah. Hmm. Mhm. So yeah, let's see what the news are saying. If the news are
An interest income number that you just referred to for Bank of New York.
nah, nothing much. Just some old guy speaking about his bank or something like that. I don't even know. Alright, so this is starting to come down, but you see how slow this is coming down? I can't trust it. I just don't trust it. But like I said, I've got a line over here. I want to show you guys somewhere here. There is a level here. There is a level. There's a level here that I think things can go. It can go down to 113. Now, once it goes here, I don't know. I don't know, because it could continue to decline, and I could make a lot of money, or I might hedge it, and then I'll lock in how much was the loss be? 87 pip loss, which is not bad. You know, this is how you manage the trade. You know, you can manage it, because right now it's going crazy, man. This is starting to go back up. You know, I think my average is kind of higher on this one. To lower this, but this is, I bought it here somewhere. Just dipped and dipped, and this is just. But when you get these dips and dips and dips, there's going to be one big green candle coming, man. I don't know if it's hit here now. It doesn't. I don't trust it. You know, keeping it real with you guys. It's just, yeah, I don't trust anything that's going on right now. But yeah, I don't trust anything that's going on right now. But yes, stay safe, man. That's all we gotta do right now.
Are you expecting an unvarnished view of what they think is going on right now, or do you expect them to take a more diplomatic approach, worried about how that might turn out with the administration in weeks and months to come?
I think the way Jamie Dimon presents his thinking and what's going on is very realistic and straightforward. You could call it unvarnished, but I think he's very good at telling everyone the way it is, the way and what his expectations are. So he's not going to sugarcoat it or candy coat it. Nor will I don't think any of the other CEOs. That they'll be very practical and straightforward about what they're seeing, what their business customers are telling them about their borrowing needs, and what the opportunity is for loan growth. That's going to be another big topic is we expect the loan growth numbers to be much slower than what we all thought in January.
It's the real-time data we need right now. Gerard Cassidy of RBC. Stay close in the pre-market. JP Morgan higher by something like 1%, 2%. Lisa, we can't depend on economic data at the moment. People say it's dated. This is a real-time look at the U.S. economy coming from the bank CEOs over the next hour that I think is so important in a moment like this.
How much are they preparing for some sort of recession by building reserves, even without any visible deterioration in credit loan losses? How much are they discounting the resurrection of all of those mergers and acquisitions that we were supposed to get? Are those off the table now? And just how much are they preparing for bad times ahead, especially given that the source of volatility is in the safe asset, the Treasury market?
Earnings season kicking off on Wall Street. Equity futures up by 0.8% with an update on stories elsewhere. With your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Bank of New York Mellon saw a 6% increase in the first quarter revenue and a 21% profit jump. But the results don't factor in recent market turmoil caused by President Trump's tariff rollout. The bank warned of an uncertain outlook ahead as it undergoes a continued cost-cutting overhaul. Elsewhere, Mexico is vying to protect its auto shipments to the U.S. in the wake of President Trump's 25% tariffs on cars. A trade official says that the country is looking for ways to move parts of the production process to the U.S. to increase the deduction. He said Mexico's goal is to have one of the lowest tariff rates of any country in the market. In Europe, leaders are reportedly planning a trip to Beijing for a summit with President Xi in late July. The South China Morning Post says that the trip indicates a serious effort from the EU to re-engage with Beijing. The U.S. and China are also starting talks to end the EU's duties on EVs from China amid tensions with the U.S. over tariffs. And that's your brief, John.
Hey, Danny, thank you. Danny Berger there with the latest. Up next on the program, earnings season kicks off on Wall Street.
Investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, that's what the market sort of needs to hear.
In just a moment on this program, numbers from JP Morgan, reaction from Gerard Cassidy of RBC, and Sonali Bassett will break it down. From New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I think we're ready.
Ready? Go.
Africa.
There's a lot going on right now.
A region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
That's it, huh?
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Just seconds away from numbers from JP Morgan and Wells Fargo. Can the earnings from the big banks improve the mood on Wall Street? Equity futures at the moment positive by 0.7% on the S&P. Under surveillance this morning. Earnings season kicks off on Wall Street.
The whole capital markets renaissance is just not quite happening. But trading, you know, as you can imagine, given all this volatility, trading could be lights out for this quarter. The reaction of banks really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, that's what the market sort of needs to hear.
Numbers from Wells Fargo just crossing. To break it down, here's Shonali Basak. Hey, Shonali.
John, we're taking a look at Wells Fargo coming through, and of course, in addition to looking at the loan loss provisions, we are looking to see how their return on equity is. Their net interest income is holding in at $11.5 billion. Now, that is less than expected. That sets the tone, doesn't it, for the rest of the bank earnings season, particularly for the many, many regionals that are going to look at potential lending income under pressure. You are not seeing shares reacting, but remember, Wells Fargo did fall more than, for example, JP Morgan has this year. JP Morgan only seeing a decline of roughly 5% on the year. We are, however, also seeing JP Morgan numbers coming in. We'll also give you the guidance. We are watching guidance closely from these banks. Wells Fargo still sees full year net interest income growth to 1% to 3% higher. So that is a very promising sign coming from a bank where people have been somewhat concerned here about the trajectory of consumer lending.
So, Shonali, it's a miss on net interest income, but as you say, the guidance is still okay. It's difficult to guide in this moment. I would say it's difficult for analysts to even come up with an estimate for the first quarter, considering the warnings we had from elsewhere. As you say, Shonali, JP Morgan numbers out just as well. What do you see?
A few things. Provision for credit losses at $3.3 billion. We'll dig into that in just a moment here because that is a smidge higher than what we had been seeing analysts estimate. However, you are seeing the stock really shrug this off. You are seeing fixed income sales and trading revenue come in just a smidge below estimates here. But remember, this is where the trading estimates were estimated to be very high. You're seeing a net reserve build of almost $1 billion, around $973 million. Equities trading did come in above estimates, John. I think this is where things get really interesting here because remember, hedge funds did come into this year with near record high leverage, but a bank like JP Morgan, I would say for Morgan Stanley as well, captures the retail traders as well. JP Morgan in the last quarter coming out with even new ETFs to capture the volatility and maybe even a potential decline. So you could see JP Morgan in a scenario where they win if you do, they win if you don't. They can win in a lot of scenarios here. And certainly the stock up 2.5% pre-market. That's erasing almost half the losses for the year so far.
Shonali, can I just come back to you with another number and get your thoughts on this? The net reserve build of $973 million. How important is that this morning?
You know, when I'm sitting here, you could have expected it to be worse. You can expect that they would be building this, right? You saw Jamie Dimon's recession calls be more loud than normal. For him to come out on a television interview days before earnings, how rare is that, John? And you would expect more reserve build to be cautious, but that's what investors would want to see right now. Caution from the banks in the face of this uncertainty.
Well, this economy has bigger concerns than just bank earnings in the first quarter, that's for sure. Shonali, stay close. Let's go through these numbers. So the first quarter for Wells Fargo, net interest income coming in just below expectations. As Shonali pointed out, they still see growth for net interest income for the year ahead. That's positive given the moment we're in at the moment. If you go to JP Morgan, this is what we've got for both Fixed sales and trading revenue versus, say, equity. So equity sales and trading revenue coming in at 3.81 billion. The estimate was 3.18. So that's a big upside surprise. A little downside surprise on fixed sales and trading revenue. Lisa, we often talk about volatility, the good kind and a bad kind. What did we get in the first quarter?
It seems like the volatility in stock trading was the good kind. The volatility in bond trading was the bad kind. And I guess if you talk about the whipsaws that we're seeing, this still is backward looking, so we shall see. Going forward, I think the most interesting aspects are some of the commentary that we're getting from Jamie Dimon, JP Morgan, when it comes to building reserves. It isn't as big as I would have expected, to be honest. You asked Shanali about the almost $1 billion of loan loss reserves. The commentary, though, suggests a greater degree of caution, with Jamie Dimon saying it's prudent to maintain excess capital and ample liquidity, echoing what he said in the letter, and saying that that reserve build was largely driven by changes in the macro outlook, not necessarily by what they're seeing in terms of deterioration on the underlying loans.
The stock is up this morning. JP Morgan higher by 2.6%. Jared Cassidy of RBC is back with us. Jared, you've had a few minutes to go over them. What's your reaction?
John, the numbers are good in both cases, Wells Fargo and JP Morgan. What was very encouraging was Wells Fargo did not lower their net interest income guidance for the full year. The 1 to 3% growth that you guys just reported is what they said in the fourth quarter results. Also, what's interesting is the provision for loan losses at Wells Fargo was not that high relative to the prior quarter. It was below our expectations. Now, on the other hand, as you just pointed out, John, the provision from JP Morgan, over $3 billion, that was higher than expected. But what the numbers are showing us is that as these banks build up reserves, they're still beating bottom line numbers. And so that goes to show us the strength of these companies' revenues and their balance sheets. And as Jamie Dimon put it out in the commentary, this is reserve building. It's not because there's credit deterioration today, as we were chatting a moment ago. This is for the accounting for reserves for potential future losses. And when the economy is weaker or expected to be weaker than expected earlier in the year, this is what they need to do.
Gerard, we're looking at a yield curve that's steepest going back to 2022. Yes, it's for all the wrong reasons and it's spooking the markets, but is this a positive thing for the banks that encourages your view, at least on their net interest income?
Yeah, very good point. When you think back, it's 20 years that we've seen the Fed funds rate above 3% with a positive slope to the curve. So even if the Fed cuts 2 or 3 times this year, if the 10-year stays over 4%, that type of interest rate environment with the positive slope is very positive for net interest income for all the banks.
How often have you seen this, Gerard, where the rhetoric is incredibly negative, but the actual numbers are not, both with respect to the credit build, the loan loss build, which is, yes, almost $1 billion for JP Morgan, but it could have been worse with Wells Fargo coming in below. How much does this resonate with another period versus really unique, where there really is a black box ahead of us?
Yeah. We're in uncharted territory because the new account, relatively new accounting came in on January of 2020. Now, granted, we had the pandemic and the banks had to rush to build reserves only to reverse them out in 21 and 2022 since the economy snapped back so quickly due to the government stimulus and the Federal Reserve actions during the pandemic. So this is the first real test of the new accounting, building up reserves. The idea was to get out and ahead of any credit issues. It's more pro-cyclical. The banks have been very critical of this reserve building methodology because it may force banks to pull back on lending. But right now, this is the first time we're really going through it. And as so far, the banks can handle the buildup in reserves due to the strength of the revenues and the interest rate environment they're working in.
Hey, Gerard, hang tight. Just took another leg higher in the stock. JP Morgan up by 3.7%. Check out this headline. Shanali Basak has more. Hey, Shanali.
John, some things that I'm taking a look at here, of course, is exactly how much people are still borrowing at JP Morgan. You are seeing the consumer in good enough shape that the debit and credit card sales volume are actually up 7% year over year. And so things look pretty good in the face of what has been a very challenging environment. I would also say in the face of the volatility we've seen, and remember, this was the first quarter, they do still see full year net interest income about $94.5 billion. That's higher. That's higher than the previous estimate. So they're still expecting to make money on loans, and you are seeing it in the credit card books at JP Morgan. Last thing I'll say, I took a look inside their supplement at their value at risk, because in these markets you take a look at how much these trading desks
Well, I
are
need that
getting
euro to go
stretched.
down a little bit
Certainly
more
it
so
is
I can just
higher,
reduce
and
some
it
risk.
is meaningfully higher in the equities business and in the commodities business, partially as you'd expect, not yet in fixed income. My question for Jamie Dimon is, how much risk is this bank willing to take on?
Shanali, thank you. Just a final word,
crazy,
that was
man.
the headline I was looking for. Full year net interest income about 94.5 billion. They had seen about 94. What do you make of a headline like that in a moment like this?
John, that's actually positive for JP Morgan, because you might remember when they've talked about their net interest income numbers during a period of falling short-term interest rates, that kind of lowers their net interest income, because generally their duration is on the shorter side compared to some of their other peers. And so for them to come out and give that kind of guidance with the expectation that the short end of the curve is going to come down, again, is encouraging and positive. So when you look at, you wrap it all together, the numbers are good, as we expected. Nobody was expecting bad numbers on the first quarter, but the outlooks aren't as negative or threatening as maybe some people were expecting.
Jared, appreciate it. You're going to stick around, I know. We'll catch up with you when Morgan Stanley comes out. Jared Cassidy there of RBC. Elisa nailed it. The difference between the rhetoric and the actual numbers, that is a positive guide from JP Morgan.
Talking about net interest income, this goes to the upside of a positive yield curve, but all around, as much as they are preparing for possible negativity, there clearly is an eye toward not losing market share and having a very stable position heading into the next leg of turmoil. It is a different time than back in 2008, despite all the comparisons.
Stock is up by 3.7%. Up next on the program, we'll catch up with Sarah Hunt of Alpine Saxon Woods, the U.S. Energy Secretary Chris Wright, Jared Cassidy of RBC will be back with us for Morgan Stanley, and Greg Peters of PGIM. From New York, surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Building another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day.
Oh man.
And wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The U.S. is exceptional. Still the most dynamic economy, still the biggest financial market.
The outlook has been very, very bearish on U.S. equities.
Growth is still going to be at or close to flat for this year.
Whatever your economic assumptions were, they've got to be lower today.
We are far from out of the woods here. There is a slowdown coming in the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Come on, man. I need this euro to go down more.
Of the year so far in the S&P 500. What a wild week it's been. Equity futures this morning positive again by 0.6% on the S&P. On the Nasdaq 100 higher by 0.7, even with retaliation from China. It is so difficult to internalize these numbers now. China putting 125% tariffs on the US after the US put levies on China to 145. We need to focus on the banks this morning. This from JP Morgan. JP Morgan coming out with new guidance. Lisa, I think this is absolutely phenomenal. For a moment like this to come out and say, you know what, we'll raise our guide. 94.5 on net interest income. They had seen about 94.
This is a time where the rhetoric is, this is a very turbulent economy, from deregulation, trade wars, let's raise our excess capital. This could be a real game changer. And by the way, our profitability is going up. Our net interest income, as you said, $94.5 billion versus $94 billion. It goes to this ultimate question. We are in a moment of catastrophic language and rhetoric and very hot tempers and very big threats and historic moves potentially. But at the end of the day, companies are doing pretty well, and banks are in a good position to absorb this and build capital. And this is the dissonance that a lot of investors are striking against.
That stock is up by 3.3% in the pre-market. Let's get to some of that language from Jamie Dimon of JP Morgan. Anne-Marie, he says it's prudent to maintain excess capital and ample liquidity in a moment like this.
So he doesn't say Trump by name in this statement, but he's talking about Trump in this statement. The economy is facing considerable turbulence, including geopolitics, with the potential positives, though, of tax reform, deregulation, there's negatives of tariffs, trade wars, ongoing sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. A long list of worries, Jonathan, from all of these banks, especially Jamie Dimon, because of what's coming out of Washington, D.C.
Let's talk about a few of the words that came out of Washington yesterday. The President of the United States, there will be a transition cost and transition problems. Who's going to pay that price in the quarters to come?
It's a great question. This is the ultimate question. Is it going to be consumers? Which consumers? At the high end, maybe there is some capacity, but we have seen with Walmart, they're going to try to take share by absorbing those costs in their margins. This is the ultimate question. What does an adjustment period look like? What is on the other end? Because we still don't have a sense of what the goal is. Is it a full decoupling, or is it something that is a new rules of the game that is still at least playing the game?
Equity's pretty volatile this morning, as you might expect. Once again, equity futures this morning positive by 0.6%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as China imposes 125% tariffs on US goods. We'll speak to the Energy Secretary, Chris Wright, on President Trump's push to drill, baby drill, and Greg Peters of PGIM Fixed Income as Treasuries start trading like risk assets. Bank earnings kicking off in the last hour. Bloomberg's Shanali Bassett can break it down. Hey, Shanali.
Good morning, John. You are seeing JP Morgan shares higher after they said that they expect more net interest income this year than earlier expected. They raised their projection for 2025 by about $500 million. And you also see provisions for loan losses coming in higher, though investors clearly shaking that off because JP Morgan tends to be conservative. Of course, Jamie Dimon all week has been warning of increased uncertainty in the macroeconomic environment. You also see Wells Fargo higher as well because they kept their net interest income guide stable. As Lisa has been mentioning all morning, you do still see a steeper yield curve. And from JP Morgan's numbers, you also see an inclination from customers to borrow, particularly those debit and credit card loans still up by 7% in the first quarter, even in the face of this uncertainty.
Shanali Basak on the latest. More from Shanali later this morning, 7:30 Eastern Time. You'll hear from Morgan Stanley. This line from Jamie Dimon: we hope for the best, but prepare the firm for a wide range of possibilities and scenarios. That range of scenarios, incredibly wide. This is what Sarah Hunt of Alpine Saxon Woods has to say. The damage has been done, both to markets and to sentiment. Goes on to say, what we do know is that the uncertainty is likely to continue. Sarah joins us now for more. Sarah, good morning.
Good morning.
How much weight can you put on the guidance from the banks this morning?
Well, I think it's interesting that they're giving guidance at all, because I expected a lot more of a, not necessarily polling guidance, but a larger uncertainty. We were going to bracket things. So I think that there is a call to strength there that says, you know what, we see what's going on. We see what's going on in the fixed income markets, and we see that this is actually going to be a decent year for us. And I think for the bigger banks, that's an easier thing to say than it is for some of the smaller banks.
Think how positive people were coming into 2025. Sentiment sky high, loan growth will improve, capital markets activity is going to be fantastic. Lisa was asking this question in the last 30 minutes or so. The capital markets activity now for the financials, delayed or derailed? Which one is it?
I'm going to say delayed. I don't think it's necessarily derailed. I think that ultimately, you know, what was interesting about the comments that you brought up earlier, Anne-Marie, was that in that long list were some of the things that are supposed to be positive, which is the deregulation and which is some of the mergers and acquisitions and stuff that we were talking about going into this. But the fact that the tariffs came so soon and the tariffs came so hot relative to what the expectations were, I think has got everybody going, losing sight of the fact that there may be other things. And I'm not sure any of us know exactly what that's going to be.
Is the market reacting to the hot rhetoric, or is the market reacting to market structure issues that are amplifying moves that are then causing people to, for lack of a better word, freak out?
So this is another problem where the answer is yes, because it's all the things, right? It's both they're reacting to the moves, and there have been some ongoing discussions about what's going on underneath the markets and whether there's anything going on within the structure of the treasury basis trade, the FX markets. So I think that there's a combination of things where you get the first reaction on fundamentals, and then the second reaction comes from things that we're not necessarily able to see.
Where are we in that? I mean, is there a sense that there's something that just blew up, or there's something that's in the process of blowing up, and we're watching it and then creating a narrative around American exceptionalism around it, and then adding some talk about that, and everyone's running to the edges and just hiding? I mean, I'm trying to figure out the anatomy of what is going on after a really tumultuous couple of weeks.
I think that you are not the only one. I think all of us are trying to figure out what's been going on underneath the surface, and or the size of some of these moves, how problematic that is, because so many firms have levered up more and more as we've had less volatility, and then you get volatility that is off the charts, and you have to think that there are some reactions to that, and some of those are going to be people making a lot of money, and some of them are going to be the opposite. And I don't think we have an understanding right now of which is the bigger piece of that, as money also moves out of the U.S. and goes to other places, which are smaller than the U.S., so therefore the effects are magnified. So I think that there are a lot of different parts of that equation, and I'm not sure that we're able to simultaneously solve it right now.
The Treasury Secretary said yesterday they're going to go through the queue when it comes to these deals they're making with other countries, and then there's going to be a period of, quote, great certainty after these 90 days. Is that what you expect, 90 days, and you get some certainty in the market?
I would love to see great certainty in 90 days. I'm not sure that you're going to get great certainty, because I think that as we go through all of these things, there's going to be continuous changes. So I think that if you take some of the uncertainty off the table, which we haven't yet at all, and I think that there was some expectation that once the announcements were made, that was going to be a catalyst in and of itself from an uncertainty standpoint, and all it's done is ratchet that up. So I think that there is going to be some, as you start to get deals through the pipeline and people start to understand what they are, I think that will help calm things down. But right now we're still in that phase where that hasn't happened yet, and I think that max uncertainty that we all keep hoping to get behind just continues on a daily basis.
The forward multiple on the S&P doesn't scream recession right now. Cameron Dawson made that point in the last hour. From your perspective, given the price move we've already seen, do you think we have the capacity to absorb bad news now, going into the next several months, where we might see some pretty big downside surprises on data?
Well, I think that we came into this year with the market at an even elevated multiple than it was right now. So is it back to a place where you can feel very comfortable with it? No, which is why I think that you've got risk to the upside and risk to the downside, because you get really good news and this market wants to take off. You get really bad news and we can say, you know, the multiple's still expensive and it can still come down a little bit. I think that what we're looking for is a very choppy year, unfortunately, and some hope that as you get through some of these issues in terms of understanding what's going to happen, that people can start making decisions, and that delayed economic activity doesn't accelerate too much.
So in the meantime, we just want somewhere to hide. Some people do anyway, some people more aggressive than that. But if you want a tin hat and a rock to hide under right now, it's not the Treasury market. What is it?
It's not the Treasury market. It's some of the areas that have done fairly well in general recessions, those things like consumer staples that got really, really cheap at the end of last year, and everybody was looking for more exciting things and more growth. And then you look at those multiples and you go, you know what, that's not so scary. Some of the defense stocks have gotten killed also. And so I think that there's some opportunity there. There are some places, even something like Walmart, look at the big banks. There are places where they can absorb it. I think the harder thing is going to be for smaller and mid-cap stocks because the uncertainty is very high right now. And I think for them, it's much more difficult.
I want to sit on one point that you said and make this full circle. The big banks, coming into this year, a lot of people were really excited about them because of the growth in the economy that they were expecting, as well as deregulation wave. That's something that we heard from Jamie Dimon, that the deregulation is going to be a real positive. We also are seeing that steeper yield curve that could also benefit these banks. In some ways, are the banks a haven in good times and bad, given how much they've built capital and what a different position they're in now than pre-pandemic?
I think that it's a much different situation for them now. But I also think if you look back when all the technology stocks are outperforming, the banks are underperforming. So in good times, they tend to lag a little bit. And in bad times, I think people go, oh my goodness, there's a great business model. And we're all looking at cash flows. We're all
this is going to be crazy.
Things become of importance when you
Say hello to my little friend.
Fuck!
Oh, you hit it! Oh!
Pop, pop, pop!
What's up, guys, and welcome to another vlog. We're in Miami. Holy moly, haven't been in Miami since 2018, and my god, it's changed. But it's good to be back. The weather is absolutely fantastic, probably perfect, dare I say, 25 degrees Celsius, absolutely stunning. So we got a lot to do this week. It's the last stint of the American trip. A lot of podcasts, a lot of collabs, a lot of
Alright, guys. I'm gonna actually have to head out soon. So I'm gonna be closing the stream.